All right. Welcome, everybody, as you're getting logged in. Welcome, Facebook people. Today, we get to talk about everybody's favorite topic.
Taxes, tax planning.
Yes.
It is everybody's favorite topic.
Yep. Yeah, I think so. This time of year, it is. And you've caught the pregame here, by the way. So for
Right.
those of you who are getting signed in right now, you get the backstage pass, you get the pregame. These are the Keystone Financial Studios that you get to see us in today. So yeah, just glad you're here though. A lot of people are thinking about taxes this time of year as we get into the fourth quarter. So definitely a relevant topic. And we're going to give people a few minutes to sign in. We actually have more people registered for this webinar, I think, than we've ever had ever.
Yeah.
Which is great. So
goes to the popularity of the topic.
Yeah.
Absolutely.
Yeah. Or the pain involved, right? As far as the planning process that goes around this. So yeah, just glad you're here. And hopefully we're going to give you some great ideas that will help you as you plan for the end of the year.
And hopefully this is also timely enough that we can give you ideas and they're still actionable.
Yeah.
So kind of the reason why we put it at this time of the year specifically,
Mm-hmm.
because enough of the year has gone by that we should have a pretty good idea of what your tax picture is and what needs to happen before the end of the year to make it a little bit more optimal.
Yeah, exactly. There are certain deadlines. People think of April 15th as a deadline, but there are other deadlines throughout the year as far as tax payments that need to be made or just decisions need to be made. Like Jeremy said, there could be things that you need to do by the end of the year or it's gone, right? You wouldn't be able to do that. Or maybe that you even need to wait until after the end of the year to do something. So this is a topic that's really ripe for a lot of discussion, a lot of different strategies, and it's all very individual based off of your situation. So that's what makes it fun for us, right? It's a big puzzle that we get to work with each individual and kind of work with your basket of stuff. So we get into the topic today. We're going to be talking about general stuff, but hopefully you'll be able to apply it to your situation.
Absolutely. And we really did try to just pull together, quite a smattering of tax topics. I think that
Yes, it
the
is
ones that are most out there, that are most, affect most everybody.
Yeah, probably the ones that we hear the most, that we see the most, right, in people's situations. So we want this to be relevant. We certainly want your questions. So we're getting to the top of the hour. We will officially start the webinar, but certainly use the navigation, use the chat feature. We'd like to keep this interactive. So as we see everybody signing in, just know that that's one advantage that you have because you're here live, that you can ask questions and really pick our brain with stuff that might be going on in your situation.
Absolutely. Yep. You can find that Q&A section. It should be a little button at the bottom of your screen. If you hover your mouse down there, feel free to add those in at any time. We'll try to keep an eye on it. So if it's pertinent to that section, we might try to answer it right then. Otherwise, we will definitely grab everything at the end.
Yep. Absolutely. So, and today we are recording this webinar. So for those of you who would like to listen to it over and over, maybe if you have trouble falling asleep at night, that sort of thing, certainly you can not only review it yourself, but certainly pass it on to any friends, family. We like to make things that are shareable, whether that be the podcast or that would be our webinar topics.
Absolutely.
So with that in mind, we'll get started. Welcome everybody to the Keystone Financial Studios. You've got myself, Josh Nelson, and Jeremy Busch, certified financial planners. Means we know a lot of financial stuff. We've had a lot of experience. We've passed a lot of really difficult exams. More than anything, though, they say Jim Collins in his book Good to Great, he actually talked about expertise and that it takes about 10,000 hours to master anything. And for most people, that takes about 10 years, right? If you really work at anything, whether it be Taekwondo or speaking a foreign language or the financial world, it takes a while to do that. Just so happens we have that experience. We have that 10,000 hours in. So that's something that you can learn from us, not only from our own knowledge, but also all the client situations that we run across. So the topic that we're covering today applies to everybody. So it doesn't matter how much income you've got or don't have it. Everybody is going to have some level of tax planning that they're going to need to be doing. So very relevant for everybody.
Absolutely.
Yeah.
Yeah. And then really how we kind of attack the situation as well. If I don't know if you want to go to the next slide.
Of course.
But if you are a client, you've probably seen this before. We keep it out on the table all the time, like to share it. But really, this is kind of how we attack financial planning. Obviously we do that left side of investment planning and whatnot, take care of all of those, but really there's so many different things attached to your financial planning and how it all works out over time, that we have to look at everything. And so today, obviously, we're going to do a lot of focusing on that right-hand column of that tax planning, things of that nature, losses, credits, things of that. But really, it's just another one of the many things that we like to look at when we do your financial planning.
Yeah, absolutely. And for those of you who are listening to the Wiser Financial Advisor podcast, this is a resource that we're able to send out to you. So feel free to let us know. You can email us directly at communications@keystonefinancial.com, and we will send you a PDF copy of the document. But making the complex simple, it's a complex world, right? Financially, the world is very complex, not only because it's designed that way, but also because it changes constantly. The rules change almost every year, right? They change as far as what you can do, you can't do. So it's something that you really have to keep up on.
You'll probably hear us say that a couple times throughout this presentation.
Yeah, we'll add a lot of qualifiers in, right? Which brings us to the disclaimer, right? Which was written by some really smart attorneys. But basically, everything we're talking about today is just our thoughts. These are our opinions. We are not tax advisors. So you need to talk to your own tax advisor to get a authority, right? As far as whether you can or can't do something. We spend a lot of time doing tax planning with clients, though. It's a topic that impacts everybody. And whether your focus is really on retirement planning or your employee benefits, your investments, taxes are going to fit into that. That certainly is going to be something that's going to affect your situation. So everything we talk about, just our opinions, but I think a lot of good things to consider, at least on your end. So don't consider this to be tax advice. This is just our thoughts and our hopefully triggers, right? As you start to make your own punch list of things that you need to look at or consider in your own situation. So first thing, we always construct a couple of financial statements when we're meeting with clients and prospective clients. For those of you who aren't clients, that means that you're future clients, right? But we're going through and putting together those financial statements. One of those would be the balance sheet. The other one would be the cash flow statement. Would you describe those, Jeremy?
Absolutely. So your basic balance sheet is really just assets and liabilities. It's a snapshot in time. It's a where am I today, right?
Yeah.
It's usually pretty easy to pull because it's you can look at bank statements, you can look at any other kind of statements and say this is the value of this account at this time, right? Whereas cash flows, that tends to look more along the lines of income and expenses and then project out into the future. Which is kind of more like telling a story, right? It's
exactly.
So this is what our plan is right now, and this is what we're thinking. But we know as well as probably most of you out there that those can change on a whim. They can change all the time, and sometimes a lot. So that's why we call it financial planning, as opposed to a financial plan. The days of getting a 3-ring binder full of your financial plan is pretty much dead and gone, and just because it is a moving target.
Yeah, it's funny though. Back in the day, I think a few decades ago, probably at this point, right? But back in the day, that's what you would do, right? If you wanted a financial plan, you would go to a financial planner and you'd pay them a bunch of money, and they'd produce a bunch of paper, and they'd look at that paper with you. But tomorrow, it's not really relevant anymore, right? Because the market changed and Congress made a bunch of changes, and you changed jobs or you decided to retire early or whatever, right? So that the information is irrelevant very, very quickly. So that story, it's an evolving story because it's your story, right? It's your situation, and you kind of reacting to the world, right? The financial world and those things changing around you. So those are the things we spend a lot of time with people. But as you're reviewing the end of the year and you're trying to figure out, well, how do I wrap my arms around this, right? As far as figuring out what are some things that I might be able to do or not do towards the end of the year, reviewing those sources of income. Where did you get income throughout the year? Whether it be dividends, your job, if you're self-employed, whatever sources of income you've got, compiling the expenses and then optimizing your taxes and all of this. Because if you're especially if you have really high taxable income, sometimes there's opportunities to defer that. For example, let's say that we were thinking about selling the stock and you had very high taxable income this year, and maybe we're already into December. Well, maybe you wait until January, right, to sell that stock so you don't create more taxable income this year. Could be other ways. Maybe you have the opportunity to defer other income like 401k contributions. We'll get into that. Sometimes we'll actually take losses on purpose. We call that loss harvesting, tax loss harvesting. So that's where we get involved with clients, right? As we're kind of looking at, well, these are all the considerations, right? These are all the things that I've got, my basket of stuff, my assets, liabilities, income and expenses. And here are the different tools that I have really at my disposal to handle them. So sometimes we have the ability to defer or to accelerate income and expenses, and we want to take a look at those things.
Absolutely. Yep. And then of course, so one that I would say this one is probably just about everybody hits on at some point, right?
Mhm.
Capital gains, capital losses.
Yeah.
So obviously the capital gains or loss is anytime you sell something inside of a taxable account. That includes if you're doing stock options at work, any of that matter. If there's a gain, you get a capital gain, loss, capital loss. They do net against each other. So like Josh was saying, this is one where we do a lot of, we look at it every year. Depending on what's happening in the market, loss harvesting can or cannot be a thing. Just kind of depends on where it goes. I know last year we did a lot of this because the market was down.
We did.
But we got to take advantage and kind of save some people a little bit of money on their taxes. This year, who knows? So we're about middle of October right now as of this recording, and we'll see where it ends up between now and then, but that's something that we're always taking a look at.
Yep, absolutely. So yeah, tale of two markets though. 2021, basically everything went up, right? It was really hard not to make money that year. 2022, just the opposite. Sometimes, obviously, we can't control that, right? But sometimes there's ways you can take advantage of it.
Absolutely, no matter up or down.
Yeah, the one thing to think about here too is that it may not even be investments in an account. It could be real estate, right? You could have capital gains or losses from selling that real estate. It could be other types of assets. Maybe you have physical gold, or you've got some other assets that really don't show up in a traditional brokerage account. So it's important to look at that and understand the rules, of course. As far as that netting effect, if you're at a net loss, you can carry those losses forward until they're used up. But the net loss you can take right now is $3,000 per year. In other words, let's say that somebody sold a bunch of stock and they had a bunch of other stock that some was a gain, some was a loss, but you ended up at a net $6,000 loss. You can only use 3,000 of it this year and then carry the other 3,000 forward to next year.
Yeah. So and kind of to distinguish that. So gains and losses net out throughout the year. But what Josh is talking about, the 3,000 per year, that's 3,000 against ordinary income.
Right. Exactly.
Right?
Yeah.
So if you
had
had
best to offset.
Absolutely right. So if you had $20,000 in capital gains and $20,000 in capital losses for the year, no matter short term or long term, that would basically net out to zero. And so you would have no capital gains or losses for the year. The ones that when it is higher, the losses are higher than the gains. That's where you get 3,000 per year. But this is something to consider also for, I would say, many of our clients. So if you did have a bigger than $3,000 capital loss net last year, you can carry some of that forward to this year. So you can use against 3,000 again against your ordinary income. So keep that in mind when you're doing taxes.
Yeah. Another thing to keep in mind too is the holding period, long-term versus short-term. Yep. So long-term meaning that you need to hold for over 365 days on an asset to have the long-term capital gains treatment, which is substantially lower. So it's a substantially lower rate than the short-term rate for people, because that short-term rate is your ordinary income tax bracket. So don't make the mistake. Sometimes people do, right? Where they have something and they come like one day short, where they end up selling something.
We have seen that.
Yeah. Let's say you bought like an Nvidia, or something like that this year where it's just skyrocketed and you end up selling it less than that 300 or 365 days or less. All of a sudden, boom, your tax rate could very well double from what it would have been if you had just waited until after that year.
Absolutely.
Yep. So just be aware of the rules again and how those work. We spend a lot of time on that. We do our own trading, so we're able to see that. And not that you ever want to make decisions just because of taxes. Investment reasons first, tax reasons second, for sure. Yeah, I've seen that happen in a lot of cases. People will defer gains and defer gains and defer gains and accumulate a boatload of one company's stock just because they're afraid to pay the taxes. And then, of course, something happens eventually, which it will, to every company. Then the stock plummets and all of a sudden, gosh, I wish I could have gone back and paid those taxes. I heard that a lot in the early 2000s, late 90s, early 2000s with some of the big tech stocks. So don't make that mistake.
Absolutely. And then, of course, retirement contributions. So now these are things that can directly affect you as far as what kind of now I can't even think of the word, probably because we're live to everything.
Yeah, exactly.
The things that you get to count as deductions. There's the magic
Right.
word. So obviously your 401k, that's low hanging fruit.
Mhm.
Contributing to your 401k, if it's pre-tax, of course, it might fit into your situation. And we do have some of these where most 401ks now offer Roth inside of them as well.
Yeah.
And so depending on what percentages you're paying in is going to directly affect ultimately what you're paying in taxes as it goes along.
Yeah, absolutely. That differential there too is huge because you're electing when you choose, do I do traditional or do I do Roth? We get that question a lot. That's a very common question, is which one should I do? Really, there's no right or wrong answer there because we can't predict the future as far as what are going to happen to tax rates after this year. All we know is what they're going to be this year. And Congress could even change that if they wanted to, right, by the end of the year. Not likely, but basically what you're doing is you're making the bet of, do I think my tax rates are going to be higher now or later? So if you think that your tax rates are going down in the future, and most people aren't saying that. Most people are saying, no, I think tax rates are going up, $31 trillion of debt, unfunded Social Security, Medicare, and so forth. Tax rates are probably going up in the future. So the person that does Roth is making the conscious decision to forego the tax benefit in the hopes that down the road, I'll get these tax-free distributions, versus traditional says, no, I want to take the tax advantage today. And the reality is it may be both. You actually could do both contributions. Absolutely. You could split the difference and say, you know what, I don't know what's going to happen to tax rates, so I'm going to do half in each. Either one of those is fine.
Yeah.
One other point on the 401k too is that sometimes you might say, I don't have a 401k, I have a 403b, or I have a 457 or something else through your employer. Sometimes they're called different things. If you're in the government, you'd be a thrift savings plan participant. Para 401k if you're a state of Colorado. There's all these different things that get thrown out, but the bottom line is that they probably have both a Roth and a traditional option in those plans. They all more or less mean the same thing, but it depends on, do you work for a nonprofit, right?
Absolutely.
A municipality.
Yeah, so a lot of those plans, and really where they all come from, 401k, 403b, 457, it's just the tax code line item,
right?
That names it, and it does depend on that. So this is one of those areas that is very specific to each individual. It depends on who you work for. Do you work for a municipality? Do you work for a school district? Sometimes a lot of the nonprofits like school districts, you can contribute to a 403b and a 457. Really great opportunity to plow away a lot of tax-free money or combinations thereof. But the thing to keep in mind with this, and then the difference between 401k and IRA is that there are contribution limits, and kind of going back to our disclaimer is that they're always moving, right? So contribution limits, for instance, this year, 2023, if you're under 50, you can put up to 22,500 into your 401k. That's your money. That doesn't include what your employer contributes.
Yep. Good distinction.
If you're over 50, you can put an additional 7,500 in there as a catch-up contribution. And other things like IRAs. So IRAs, those are basically at 6,500 this year. Again, under 50. An additional 1,000 catch up, but those have income limits.
They do,
depending on if you file taxes single or if you file taxes head of household or married filing jointly. So if you make too much income, the IRA contributions might very well be phased out. And traditional IRA contributions and Roth IRA contribution phase out limits are not the same.
Yep.
So these are things where
it depends,
but it's really important to check and to know this stuff, or just ask the question. If it's specific questions, we can answer those for you as far as what those contribution limits are. But it's important to know because there can be penalties if you say, well, I really want to contribute to a Roth, but you make too much income. That's what we'd probably call a first world problem, but
it is.
that doesn't mean that you need to pay penalties just for that.
Yeah, and as you can tell already, even just 10 minutes, 15 minutes into this presentation, there are a lot of gotchas. There are a lot of it depends, answers. So you can ask us a lot of these questions, and especially if we don't know you really well. Of course, if you're our client, we probably know you really well, right? And you know your financial situation. But when people just ask us kind of off the cuff, well, hey, should I do Roth or traditional? Should I do an IRA or a 401? It depends, it depends on your situation. Let's learn about what you've got going on and also what you believe. Sometimes these things aren't knowable, right? The story that we talked about before, those assumptions that we make about the future, we don't know, right? Some of those things are just going to be dynamic and we can't predict them. So
absolutely,
what we're trying to do though is make the best decisions we can based off of what we know, what we think is going to happen, of course, whether it be investments, retirement planning, any of this stuff.
absolutely.
So yeah, definitely, think about that though. It'd be thinking about after-tax versus pre-tax contributions, what situation you're in. One example, for example, let's say that you are retiring at the end of the year, and this is going to be a huge income year for you. You might decide to do the traditional contribution in your 401k simply because your income is going to plummet after the first of the year. You could take that money right back out and start spending it at probably a lower tax rate.
I would say also this one is one that we look at a lot more in the spring. Obviously, IRA contributions you can still do before the end of the year. Most of them you can do up to April 1st of the next year for this year's taxes, right? So you can still make IRA contributions up until April 1, 2024 for the current year to affect this year's taxes. 401k stuff, we're middle of October right now. So what's happened inside your 401k is mostly set at this point.
Yeah.
But this is one where, if you go through the tax year and you end up in a specific spot with taxes, this is one where we may look at in the spring and say, hey, for this year, maybe we do make that adjustment and we shift a percentage or two into Roth or into traditional if you ended up paying too many taxes.
Yeah.
It just depends on your situation.
Yep. Absolutely. One thing to note too is if you're self-employed, there's a whole other world. we could do a whole presentation just on retirement plans, for self-employed individuals. So if you're in that situation, say if you're a contract worker, you got your own business, something like that. We've got quite a few clients in that situation. There are special plans for you, and they can be really good. Actually, there can be some great advantages there. So keep that in mind as well. That the things that we're talking about, you have your own special version of that stuff that will probably allow you to do a lot more, maybe than if you worked for a company. So one of those advantages.
Absolutely.
Lots of stuff. Again, lots of stuff. We could do a whole presentation on any one of these slides, by the way.
Entire presentation on
right. Yeah. Charitable giving.
Absolutely.
Yeah.
So this is a good one, especially if you are already charitable minded, I would say. And so if you're already in the habit of giving and you have specific charities in mind, any kind of 501c3 organization, charitable giving can be done a number of different ways, but it does have some tax implications. Just because with the last, this is one that changes with tax code, I would say quite a bit.
Yeah.
And so sometimes, there's, especially with the last big tax update, you are either claiming the standard deduction, or if you want to do charitable deduction, sometimes you give to a charity, but you're still going to take this as the standard deduction. And so you don't really get the benefit of
I think it's 28,700, isn't it, this year? For like if you're married family jointly, it's 28,700 this year,
which is pretty big.
It is.
That's a great thing.
That's huge. Most people don't. It's like 90% plus of people now. Just take the standard deduction.
Absolutely. It makes taxes a lot easier for the majority of people. But this could be one where if you give appropriately, or if you find yourself in a really high income earning year, where maybe it makes sense where I can contribute a bunch more this year and take advantage of that, kind of help it out tax wise, and then dole it out. So there's things like donor advised funds. If you have, high, a lot of stock with a really low basis, and you don't want to realize the capital gains, but you would like to still give to charity. There are ways of getting that. You don't have to realize the capital gains on it, but you still get to get the charitable giving part of it.
Yeah,
Right.
absolutely. Yeah, and from a planning standpoint, kind of what we're referring to is, say if you had the standard deduction is 28,700 for married filing jointly, or if you're single or head of household, you can kind of translate it, look at the tax charts on that. It's easily Googleable. So at 28,700, you're going to get it even if you don't give a dime to charity. But let's say that somebody's in the habit of doing $5,000 a year charitable contributions. Well, that's great. And that's really good of you to do that, right? Hopefully you're benefiting some organization and helping people by doing that, but you're really not gaining a tax advantage for that because it's below that 28,700. So instead, what if somebody said, well, over the next 10 years, if I do $5,000 a year, that's $50,000. What if I took $50,000 and just threw it in all in 1 year? So you could, of course, let's say that you're giving to the Red Cross, right? And you could just give the Red Cross $50,000 this year, and they'd probably appreciate that,
Right.
right?
They love you.
Yeah, but you might say, yeah, but I don't really like to give that way, though. I kind of like to do the $5,000 a year. Well, this allows you to get your cake and eat it too, because you could put in $50,000 into the donor advised fund. And there's a lot of, again, gotchas and details, right, that we're leaving out for sake of time. But if you got the money in there, now you get a $50,000 deduction. Say if that was your only deduction this year, $50,000 instead of taking the 28,700 standard deduction. Now next year rolls around. Now each year you could be kind of divvying that money out because you're in control of kind of how that's given out to the charities. So they're still getting their $5,000 a year. It's just that you're going through the donor advised fund to do it. So if we have you thoroughly confused, that's because there's a lot of details around this. All you need to remember though is, okay, well, if I give to charity, there's probably some ways, especially if I've got low basis stock, if I've got low basis real estate, anything like that, there are ways actually that you can get that possibly tax free. You could possibly get a charitable deduction and eliminate all the capital gains.
Absolutely. And it's different for everybody as well. And of course, and then it depends, am I contributing real estate to this? Am I contributing old stock that I have? Am I contributing cash? According to tax code, there's different percentages that you can count for each of those as well. And so it's important to know that there are those distinctions out there and those different thresholds. And so working with someone to make sure that you're doing it right. There are plenty of ways to take advantage of it. You just have to know the proper ways to go.
Yeah, know the rules. For example, the carryover period, if you make excess contributions, right? In other words, you didn't get to take full advantage maybe of the charitable deduction because you kind of hit those limits. There's only a 5-year carry forward on it. So you want to be a little bit careful too, because you could end up kind of losing some of the tax advantages simply because you ran out of time. So that's why, again, this comes down to every individual is going to be a little bit different, which is what makes our job fun because, right, it's everybody's a different puzzle, right? Everybody's situation is different.
And the rules are always changing.
They are, right.
That as well.
Yep. That's why our 10,000 hours plus of experience comes in handy, right? And then we're doing this every day. So that it's not just your stuff we're managing other people's stuff, other people's situations. We can be creative and kind of work through your own planning.
Absolutely.
Lots of good stuff.
Yeah. And then of course, HSAs and FSAs. No, again, specific rules for each one of these. These are not created equally. I think the more popular option nowadays is HSAs. As far as it goes, but current year you can do 7,750 as a family contribution to this. Again, if you're over, this one has an age 55 and older catch-up contribution. So if you're over 55, you can do an additional 1,000 to an HSA. These are fantastic plans if you don't already have one. They do have some rules as to who qualifies for it. You have to have a high deductible medical insurance plan.
That's key.
But really, you get a lot of tax benefit for contributing to HSAs. And a lot of it, the other thing is nice too, is that, once you get into kind of those upper tax brackets, a lot of these things like IRA contributions, you get phased out. You can't contribute to those anymore. But you can pretty much always contribute to an HSA.
Yeah, as of now, there's no income limits.
As of now, there's no income limits to it. But Really beneficial. So you get the tax deduction going in. If you use it for medical expenses, you get the tax deduction going out. There are ways of, if you have it long enough and you just don't need it for medical, once you get to 65, it's almost like another retirement account.
Yep.
So pretty beneficial as far as what it is. Whereas FSAs, you know, they do have some benefits as well. There is one thing that we don't kind of like about FSAs is that it does have
they're not flexible. They're not
Yeah.
flexible. They're called flexible spending accounts, but they are
Really
not.
funny.
Yes, false
But true.
advertising.
False advertising. Yeah, so this is one of those that if you are a high income earner, you can still take advantage of typically. There are, I'll tell you as well, though, if you are anywhere near Medicare age, you want to be careful with your HSA contributions because there are some specific rules regarding that in terms of the 6 months leading up to Medicare and contributions you do. And so that is definitely worth talking to a financial professional about if you're trying to maximize your HSA, but you're getting near Medicare age.
Right. Yep. You kind of get disqualified from that after you hit Medicare age. So
Yeah.
yeah, sorry, that is kind of a limit. The silver lining again, though, is that you can kind of use it almost as an extra retirement account. And we've actually got a lot of clients doing that. They're maxing out their HSA every year. They have no intention of using it for medical expenses. Yeah, they're just accumulating it. It's just another kind of bucket that they're accumulating, and they're going to use it for retirement income. But unlike normal retirement funds, which have age 59 and a half as the rule, with HSAs, it's age 65. Once you're 65, you can start pulling it out for medical expenses. It could just be used for whatever you want to spend that money on. Yeah. FSAs, we don't see that as much anymore. Sometimes they're another version of that is a dependent care savings account. The reason why they're so inflexible is it is use it or lose it. And example of this versus HSAs, you can carry over from year to year.
Absolutely.
Good example of this is we had a client that was going to get the LASIK surgery, and she had it all planned out. She was going to get it done. So she had elected through her employer to max out her FSA, or flexible spending account. And then, when the expense came up, she would use the money, pay for the LASIK. So it turns out she went for the consult and the doctor checked out her eye and said the shape of your eye, blah, blah, blah. You're not a candidate for LASIK. And so then she was frantically going to Walgreens and just trying to buy stuff, anything that could qualify, because otherwise you just lose the money right after December 31st. So you want to be really careful with that. We like HSAs a lot better. They are truly a flexible spending account versus flexible spending accounts are the inflexible spending accounts. So just to be
Funny how that works.
Yeah, be aware. And FSAs are usually just available through an employer, by the way. HSAs you can do, you don't have to be employed.
Yeah,
by
a lot
company.
of people don't know that one. We've run into that a couple of times just this year talking to clients, is that you don't have to do an HSA through your employer. You can do that separately outside of that as well. So if you don't already have one, good opportunity.
Yep, absolutely. So we beat that one to death. The business deductions, that's another one at the end of the year. A lot of businesses, from the smallest businesses all the way up to Fortune 500 companies. Apple, they've got whole, staffs of people that this is all they do, right? Is kind of control income and expenses and the timing of all of it. So that's really what we're referring to here in business deductions. First of all, deductible business expenses, anything that is deductible, usually what businesses are trying to do as they get to the end of the year is they're trying to kind of accelerate expenses. They're trying to get as many expenses as they can by the end of the year. In other words, sometimes they'll even prepay things. You could prepay January's rent. Companies will do that. They'll kind of pay ahead, in other words, for expenses if they're really not planning on using until the next tax year or the next calendar year, but they're able to take the deduction in that year or before their fiscal year. I guess it depends on how they're doing their accounting, but that's something that most companies, especially smaller companies, are on a calendar year basis for accounting. And certainly from an income perspective, what they're trying to do is kick income, like we talked about before, kick income into the next year if possible. Record keeping requirements are really important on this stuff. If I take Jeremy out for a business lunch today, in fact, I think we are. We ordered, because this is a crazy day. We actually ordered food in for the employees today. But so that's a deductible business expense,
Yep.
right? But as far as record keeping requirements, I need to keep the receipt. Most CPAs say at least 3 years. At least 3 years, you need to hang on to stuff because that's usually the window. If you're going to get audited, in other words, either as an individual or a business, usually it's within a few years, the IRS will knock on your door, send you that letter, whatever it is. So you would need to be able to produce proof of various expenses.
Yep.
And again, this is whether it's the smallest company or Apple or Walmart or whatever, right? To retain those records. A safer option would be 7 years. 7 years is kind of the standard answer that people will give, CPAs will give as far as how long you should keep your tax returns, your other documents. And of course, these days you can keep it electronically, right? You don't have to actually have physical paper anymore. So there's really not a lot of reason not to hang on to some of that stuff.
Yeah. And
Yep.
small business owners
Yep.
too. So you don't have to be a Fortune 500 company. If you
Yep.
you are the only employee and you own a business or run a business.
Yep.
You have a lot of good things that you can do tax wise
Yep.
from a business owner standpoint that flow through to your personal income taxes as well.
Right.
So
Yeah.
that each one of those is different. So that's definitely one worth kind of talking
Yeah,
about.
and that's a good distinction. You have to kind of look at what type of business you are, C corp, an S corp, an LLC, a partnership. There's all kinds of
Yep.
different entities and different tax implications there as well. So
Absolutely.
again, that's a whole other seminar. One last thing here is the qualified business income deduction. That is something that came out of the 2017 Tax Cuts and Jobs Act. By the way, one thing to be aware of before we forget is that a lot of the things from the Tax Cuts and Jobs Act actually are due to expire in 2025 or at the end of 2025.
2025.
So we need to be aware of that all the rules we're talking about right now, many of them end up changing after that year. And that's if Congress does nothing.
Yeah.
And oftentimes that is what Congress does, is nothing, right? But and sometimes that's good, right? But if Congress doesn't do anything and they don't extend on some of these tax cuts and limits and things like that, the world will change, right? A lot of these rules will end up changing. So expect a lot of talk, certainly, probably more talk than action, but expect a lot of talk the next couple of years in Congress about a lot of these deductions, limits and credits and things like that. The whole landscape may end up changing. The whole point though on the qualified business income deduction is if you qualify for it, and there are phase outs here as well. You go over certain income limits, these do phase out for businesses, but it is up to a 20% income tax deduction on business income. So be aware of that. I think it's $372,000, if I'm correct, for this year. Once you go over that limit for married, filing jointly, that does phase out, and you pretty limited or wouldn't be able to claim that at all. So truly, we're talking about smaller businesses. But there are some exemptions. It depends on what industry you're in. There's certain, industries that are kind of exempt. It could be higher amounts and so forth. Again, way beyond the scope of what we can get into today. But just be aware of that. Be aware that you may qualify for that. And some of the tax moves that you would make could make a difference there.
Absolutely.
Yeah.
Yeah.
Great. RMDs.
RMDs. Talk about a moving target. So this one has literally moved over the last couple of years, just about each year, right? And technically it's not really done moving. So for a long time, it was 70 and a half years old. Why they got the half in there, who knows? And then they changed it last year to age 72.
Right.
And then they said, you know what? We should have just said 73. So the rule this year for 2023 is if you turned 73 during this year, then this is basically your first year of required minimum distribution. Now the end goal, and so this is going to depend if you have not yet turned 73, but you are going to turn 73 or sometime over the next 5 years, your required minimum distribution age could be anywhere from 73, 74, all the way up to 75. And so there is basically this number of years of the next couple of years where it's going to steadily be increasing to age 75. And really all this is when RMD age is really just when the IRS says, all right, you've been hanging on to your traditional IRA, your 401k money too long and you haven't used enough of it yet. And so we want to get our taxes, right? And so they have a calculation that they do where they basically enter your age in. They have tables, mortality tables that they use that say, if you're this age, this is how long you should live. And it basically comes out to a percentage of your traditional IRA or that pre-tax money in total that you have that you need to take out each year.
Yep. So that changes every year. And if you're a client of ours, we figured that out for you. And we help you plan ahead. Certainly, that's something we want to make sure you don't get penalized, because if you don't take it out, it's a 25% penalty. It used to be a 50% penalty, actually. They were so gracious to lower it to 25%, but for somebody who just wasn't aware of the rule, right, and they didn't do it, and they didn't get the money out, it was a 25% penalty. Now that's on top of the taxes. That's just the penalty.
Absolutely.
So you still have to pay income taxes. So you could actually have most of your RMD go away to taxes and penalties if you didn't take it out. Just go to the government.
The other tricky part of this too is the new rules surrounding inherited IRA. So inherited IRAs have literally their own rules on required minimum distributions. And the real fun part is that they're not exactly clear yet. IRS has been playing around with that one for literally the last 2 years, and they still don't have rock solid legislation on inherited IRA RMDs. So that's all this stuff kind of plays in together, right? Like, you don't want to pay any penalties that you don't have to. You got to take distributions on this stuff, but how much? When do I have to take it, et cetera? And it really is dependent on so many things. So if you have any of these, or any of these are ringing bells and saying, oh yeah, I need to do that, or oh yeah, I have one of those, please check with us, check with some financial professional, because it's not worth paying the penalties on it.
Yeah. Again, lots of gotchas. Estate and gift planning, it fits right into that, because in the past, especially for people who have large 401ks, IRAs, and we're talking about the non-Roth, in other words, we're talking about traditional pre-tax plans. Oftentimes what people would say is, oh, just give it to the kids and they can spread it out over their lifetime. That used to be the rule up until 2017. Right. Like Jeremy said, still up for interpretation, but basically the end goal, or the end result, is that people have to take it out by the end of that 10th year following that person's death, except if it's a spouse. Spouse does have an exemption. They can continue to kick it forward. But if you're a non-spouse, it doesn't matter if you're a kid or whoever, right? By the end of that 10th year. So especially if you've got a lot of this tax deferred income, you might actually, this is where a lot of our conversations get into with clients about maybe we should start doing some Roth conversions, kind of prepaying the taxes, especially if we've got some runway here. We've got, some years to go. That can give us some really good, kind of flexibility, right, to do planning for each person and try to diversify tax wise.
It does. And that's one way that I think we kind of, your financial planning, tax planning is a bit different from, say, what your CPA might tell you, right? So obviously, we're going to do what we can to lower your taxes in any year and say, this is what you're looking at during this year and what you can do to avoid this stuff. But we also take that longer view and say, well, if you, hang on to this stuff, and by the time you get to RMD age, you're going to be taking $300,000 RMDs every year, which is going to put you in X amount of tax bracket. How do we eat away with that? But if you don't really need that much living in retirement, so kind of doing that future year planning, maybe it's 5, 10, 15 years out, but there's still tax planning that can be done now to avoid tax situations in the future.
Yeah, absolutely. So the income tax, a lot of times people think about estate planning and they hear that word estate and they think, well, that's just for the ultra wealthy people. But the reality is it's not. Everybody has an estate. Even if you just have stuff, maybe you don't even have investment accounts, you just got a bunch of stuff, you still have an estate, you still have stuff.
Absolutely.
Yep. So it's still something that somebody's going to have to deal with, right? I mean, if you're not here, somebody's going to have to deal with that. And sometimes those things are organized really well. And that's what we're talking about with estate planning, is just getting really organized and trying to use the tools at our disposal. But for some people, another thing to keep in mind is that the estate tax could apply. Again, the Tax Cuts and Jobs Act, the limit right now, again, married, filing jointly, is like 23 million that you'd have to get above that point before you'd have any estate tax. That comes down a lot. I can't remember what it is, but it's going to affect a lot more people. It's like it goes down like by half at least. Yeah, exactly. So especially if you're an individual, now you might be talking about, gosh, you have a house and a couple rental properties, a few investment accounts, that could get into a problem area really quickly. So we'll see if that gets kicked forward or not. So again, for most people, the estate tax isn't an issue right now. For people worried about that in the future, worried about those tax planning things that they need to look at. Certainly we want to look at things like gifting, like donor advised funds, using trusts. There are lots of different tools at our disposal, again, beyond the scope of what we can do today. Keep in mind, though, that everybody has the ability to do gifting. You can gift to a charity, but every year, this year it's 17,000, I think.
17,000.
Yeah,
Absolutely.
yeah. You can give to anybody. Jeremy can give me 17. I could,
Unlikely.
I could give him 7. It doesn't have to be anybody.
Right.
It could be anybody. Yeah, and if you're married, then you can actually do a split gift, which means you can double that. So, if we wanted to give, a random person $34,000, Sarah and I could do that if we wanted to, and there wouldn't be any tax implications to us or to them. Once you go beyond that point, then there are some special filing requirements. So for that reason, a lot of people, especially if they're thinking, you know what, we're not going to spend all this money. Think somebody is retired, we're not going to spend all this money. Maybe we do want to start giving money to the kids in advance.
Yeah, and that's one I think that comes up in conversation a lot too, is, but I think we have that conversation a lot with people who come in talking about their elderly parents. Because
we're having more of those conversations.
More and more. And it always comes down to, hey, mom or dad, or maybe both, may be in a Medicaid situation. What makes sense from them to, be gifting stuff. And so gifting can be a really great tool, but there are very specific rules around it. Especially if the person gifting may be in a Medicaid situation in the future. Because right now,
long-term care,
situation, any kind of long-term care situation, anything like that, where a spend down of their assets might be, might be on the books or something. But so really, that's one to talk to a financial professional about. Is it can be done. There are time constraints and look back constraints when it comes to things like Medicaid. And so you just want to be careful about it, because you could put yourself in a really bad situation if you say, hey, I'm going to gift all this stuff, and then all of a sudden now you're in a Medicaid situation and they're looking back 5 years and saying, well, what about all this money you gifted 5 years ago? And you're still on the hook for that. So
a lot of people don't realize that. They think, oh, I can just give all my money away and it's not an issue. Not necessarily.
Not that easy.
And of course, you want to talk to an attorney, you want to talk to a tax advisor. That's why it's important. You've got kind of a whole team in place. And we usually end up being that quarterback on the team, because we kind of know where all the money is. We're kind of coordinating the entire plan, but we'll certainly pull those people into the mix, right? Especially trust officers, CPAs, estate attorneys, other people that would need to get involved and really kind of like a specialist, right? That you'd pull in, where a doctor might bring a specialist into the situation once it starts getting really complicated.
Absolutely.
So finally, year-end planning tax strategies. A lot of these apply to stock, but for those of you who have employee benefits that revolve around stock options, restricted stock, any other types of benefits that would involve your company's, holdings or benefits, those are always kind of ripe for taking a look at as we get to the end of the year. So we're not going to go through each one of these specifically, but the timing is kind of key. If you have certain benefits that allow you to control the timing as far as when things are sold or received and so forth, there's a lot of things that we can do to either accelerate or wait, delay the taxes until a future year. Alternative minimum tax, that doesn't affect a lot of people anymore. Sometimes it does if you have incentive stock options. So if you're at a very high level position within your company, could be that you have those types of benefits. So we do a whole seminar on that, right? RSUs and
whole
options.
thing by itself. If you are subject to AMT or alternative minimum tax, you probably already know it.
Right.
So it's an issue.
There's it's probably one of the most irritating taxes, I think, for people who are subject to that. But again, you know who you are, so we can talk about that and how we can help you avoid that in the future. So a lot of year-end planning that really I think we can do some thoughtful, kind of looking at the entire situation, and certainly you can on your own. But again, think about the 10,000 hours. Is that 10,000 hours of experience something that you want to become the financial expert, or do you want to hire people who have already done it, who are doing it? That's really where we come into play. We've got a great team. And of course, we've got even people beyond this. We do work with a lot of great tax advisors, a lot of great estate attorneys. other professionals that are custodians, Fidelity and Charles Schwab. We've got a lot of resources, in other words, that we're able to pull in really to make sure that your planning is as effective as possible. But and taxes are a big deal, especially you get into higher and higher tax brackets. It gets more and more expensive. In other words, it gets more painful. And that's where a lot of people are coming to us saying, hey, I need you to invest my money, but this is also about, trying to reduce taxes, try to plan for the future, try to get ready for retirement, figure out when should I draw my Social Security. That chart that we had before, that services grid with all of our making the complex simple. You might be saying, you just made me really confused by this entire presentation. That's because the financial world is complicated. And it all depends on your situation. So that's why we have jobs, basically. That's why we have a profession, because we get to do this every day. So that being said, that's a lot. We went really quickly, but we do want to open it up to any questions that you've got. I can see there are a bunch of them queued up right now. So thank you. Well, while Jeremy's doing that, our contact information is on the slide, josh@keystonefinancial.com, jeremy@keystonefinancial.com. And as you can imagine, our website is keystonefinancial.com. So that is the easiest way to find us.
Absolutely. So Eric actually had a nice little piece here. So in case you aren't completely sold on the fact that tax rates could very well go up in the future. By the end of the year, it actually looks like 34 trillion in debt, not 31.
Yeah.
So, but what's 3 more trillion when you're up in the 30s?
When you're that high, yeah, exactly. It's just bad. Yeah, it's just not a great situation.
Yeah. So and that just kind of continues to go, right? It's one of those things. So here's a good one. Since we do have so many clients that either came from HP or might still be there, is the HP retirement medical savings account the same as an HSA? Yep. And the answer is no. So RMSA that's a really fabulous benefit for anybody that does have it. But it is not the same necessarily. So that one's basically works as a reimbursement type account. So I think most people that use that end up using it for things like, Medicare premiums, or health insurance premiums.
Yeah.
It has some rules about what it can be used for, but that is basically just a savings account that HP gave some of its employees once upon a time.
Yeah.
Most of them consist of X amount of dollars that you would get that you could use for the future. Pretty rare nowadays. There might be 1 or 2 companies out there that are still doing things like RMSAs.
Yeah.
But no, not HSA is very much family specific. Some of those I could see where there might be confusion because a lot of companies do offer HSAs through their benefits. Some of them might actually contribute to them for you as well as an added employee benefit, but not the same thing at all.
Yeah. Yep, Jeremy's right. It's usually a reimbursement account. In fact, in a lot of cases, they don't even call it an account because the reality is it's kind of a bank of money that's set aside for you. So that's because you probably were retirement eligible, meaning that for a lot of companies, it's age 55 and 15 years of service at least, or something higher than that. But if you're retirement eligible, you'd have kind of that bucket of money. Where this came from originally is that a lot of companies used to offer like a retiree medical program where you actually could stay on their health insurance after you left. And most companies said, yeah, it's probably not a good idea. That's really expensive. It's like this blank check, right? Basically. And so a lot of them said, you know what, we're going to just develop, and Congress allows this, right? The law allows the retirement medical savings, or sometimes just called a retirement savings account, depending on your company. But it just means that it's that bucket of money that you'd be able to draw from, usually again to reimburse premiums. You definitely want to look at the rules on it because some companies do have an age limit where, you kind of have to, it's use it or lose it. You have to kind of get the money out of there by a certain age or it just goes away. So you get lots of gotchas depending on your employees' benefits, your employer's benefits.
Yep. Next question. Here's a good one. What happens to your HSA balance when you die? What are the tax implications?
It's a good question.
Absolutely.
Yeah. It goes to your beneficiary. So you do name a beneficiary on an HSA just like you would on an IRA or a Roth IRA. I don't know the answer to that. I would guess that it's taxable on the earnings portion to beneficiaries.
Yeah, so typically think of it as another type of IRA.
We've never had it happen.
Basically, I don't know
No.
anybody that's passed away with HSA dollars.
Yeah,
in there.
they're relatively new vehicles. Yeah,
Absolutely. So that's one I'm gonna look at
yeah.
actually, because now I'm
You stumped
curious.
us.
Yeah, I'm really curious on
Yeah.
that one.
I would guess though, it's gonna probably revert to those same rules. And again, we'll get an answer. We know who asked the question, so we'll get an answer back to you. But I would guess that it's gonna revert back to the same rules as kind of that age 65 rule where you can start drawing it out, but the earnings end up being taxable to you as you draw it out. In other words, it's not completely tax-free unless it's used for medical expenses. So in some cases, really just as people get older too, naturally, we're going to have more health stuff come up. Sometimes people will keep that HSA balance even after they reach age 65, because there's a lot of stuff that Medicare doesn't cover.
Yeah.
For example, Medicare doesn't cover like anything for dental or vision, for example, or hearing aids. That's another one. So if somebody needs hearing aids, they could spend 20 grand on a hearing aid, on a pair of hearing aids, right? That happens. And a lot of times people will say, well, I'm going to wait for those things to kind of come up because it's a tax-free disbursement.
Absolutely.
Yeah.
Yeah. I mean, if you think about it logically, it's largely just a tax advantage account. Really. So I would figure if, we'll get your answer for sure, but it should work very much like a traditional IRA in terms of that. I don't think there would be any kind of RMD things, but we'll find out and we'll let you know.
That is a great question.
Yeah.
Last
First
question.
time I've ever seen that. Last question. Does 401k IRA traditional Roth partial conversions offset the RMD amount?
Unfortunately, the answer is no. Yeah. So if the order of it is the RMD has to come out first. That's the way the IRS looks at it. In other words, so if you're supposed to take $10,000 out this year, you've got they say if you take a withdrawal, it's basically that's if you took a $20,000 withdrawal right now, then the first 10 of that is your RMD. In other words, that would be awesome if you could just convert the entire thing into Roth, but you can't.
Yeah. So, and kind of to simplify that, I guess, a little bit. So as you're working, anything that you're putting into Roth, as opposed to if you do 100% contribution to your traditional 401k, yes, ultimately, because you're basically not adding as much to that pre-tax amount, which is ultimately going to cause what your RMD is going to be, right? Before required minimum distribution age, any Roth conversions that you do prior to that, yes, those would directly impact your RMD amount because you are literally converting pre-tax to post-tax. You just have to, prepay the tax basically each year. But yes, that's a lot of the reason why we do Roth conversions, is that if you're in a position where that RMD down the road looks ridiculously high or something, it might make a lot of sense to do Roth conversions before you get to that age. But as Josh is saying, once you hit that required minimum distribution age, it doesn't mean that you can't do Roth conversions.
Absolutely.
It just, you have to take the RMD first and then you can convert beyond that dollar amount.
Yep. Absolutely. So
good question.
Yeah, it is a good question. One thing to throw out as a bonus for those of you who hung on to the end here is that you actually can make a qualified charitable transfer. What's the term for it? I'm trying to blank,
QCD, qualified charitable distribution, directly from your IRA to your charity of choice.
Yeah, so that would be one way to offset that. Let's say that back to my $10,000 RMD requirement that I threw out there. Hypothetically, you actually could say, well, but I give to the United Way anyway, right? Or whatever, right? And you could actually say, well, $10,000, boom. It's going to go from the traditional IRA straight to the United Way, no taxes, because they're a charity, satisfied the RMD.
Yep.
Yeah.
Counts against your RMD. You don't have to pay taxes. They don't have to pay taxes because they're a charity.
Yeah. And then you could say, and now I'm going to do a Roth conversion for $20,000 and you wouldn't have to worry about that initial 10. So
And to throw things a little bit more crazy is that you only have to be 70 and 1/2 years of age to do a QCD because they didn't change that to go with RMD.
Nope. They should have, but they didn't. Yep. So
who knows?
Yeah. There's a lot of these things, as you can tell, a lot of legislation is put together piecemeal and by people who are not necessarily financial experts. So sometimes we end up with some really goofy rules, and sometimes those work in your favor, right? So that's definitely how we want to look at it. We are at the top of the hour, so we want to be respectful of your time. Thank you for listening today. Thank you for viewing. Certainly appreciate your business, appreciate the trust that you put in our team, which we are an awesome team. We care about our clients, and we're very well qualified at that 10,000 hours. Again, that really is something that we don't take lightly, the fact that you put your confidence in us. So with that, we will sign off for today. Have a wonderful week, and God bless.
Take care.